Hello, everyone, and welcome to today's webinar on building a more efficient private credit model, tokenization meets traditional lending. It's going to be a fascinating discussion. It feels that 2023 has been a huge year when it comes to tokenization, and perhaps we've reached an inflection point here. So lots to discuss, and I'm delighted to be joined by an awesome panel of experts who are kindly going to share with us all their insights and observations on this fascinating topic. So during the session, we'll look at a look at the market, so a market overview and the deployment potential, look at the state of industry adoption, some of the technological and ops challenges, and then look at future trends and outlook. So our panelists today, who we're delighted to have join us, is Anthony Basili, who's head of allocators and tokenization at Coinbase Institutional, Ben Foreman, who is founder and managing partner at Parify Capital, Lucas Vogelsang, who is co-founder and CEO at Centrifuge, Matthew Lowe, who's head of special projects and tokenization at Fasanara Capital, and last but by no means least, Nicholas Smith, who's managing director for private credit at our very own AIMA. As ever, if you do have questions during the discussion, please do use the Q&A button on your screens, and we'll look to save some time at the end to pick those up. Okay, well, let's get going then. Before we jump into tokenization and what's been going on in that space, I wanted to first turn to Nick to get his view on the private credit market and how that has developed over the past 5 to 10 years. So Nick, turning over to you.
Thank you, James. So I'm going to assume you're all familiar with credit, but start by outlining a few things that makes private credit a little bit different from other credit markets you may be familiar with. The first is to note that this asset class is very much a buy and hold asset class. So people are not looking to trade the instruments; they're looking to make longer term investments. Another key differentiator is that there is no intermediaries, or there are very few intermediaries. So most lenders have a direct relationship with the borrowers that they are lending to, which reduces a lot of the agency coordination problems you may have in other markets. And then finally, that the loans are non-standard. So this means that the loans themselves are tailored to the specific needs of the borrower. As before, they're not intended to be traded, so the incentivization towards standardization is much lower. There's other things you can think about. The sector's typically unrated. While we primarily think of this in terms of corporate lending, other strategies growing in popularity would be real estate lending, asset-backed finance, infrastructure debt, specialty finance, trade finance, venture debt. So there is a pretty interesting rainbow of private credit out there. You can kind of pick and choose what type of assets you like. Then just some basic sizing. So the market is circa 1.5 trillion globally. That's an estimate as of December 2022. To put that in context, it's effectively tripled or quadrupled in size over the past 10 years. We're actually publishing some data all of 5 minutes ago, showing that in 2022, we think the sector invested about 333 billion globally. So that gives you a sense of the scale and growth that's currently available. And on many measures, private credit is forecast to ultimately outgrow private equity. So it's an improper proxy, but I was looking at data today that sets out the total number of corporate lending out there to corporates in the banking world. It's somewhere in the region of 85 trillion. And so while I wouldn't expect all of that to ultimately move into the asset management sector, it gives you a sense of the total addressable market just for corporate lending. And that's before we get into some of the other strategies that I mentioned earlier. So that's my overview. Back to you, James.
That's really helpful. Thanks, Nick, for providing that overview. And I think, phenomenal growth, as you said, over recent years. Lucas, wanted to turn to you next because I hear a lot that blockchain technology and tokenization have the potential, I suppose, to revolutionize the private credit market, lending market. But why is that exactly? And Nick sort of set out how the growth has been phenomenal. So if today's way of doing things broken or in need of being fixed or improved, I suppose what is the case for tokenization in this particular space?
So I think tokenization ultimately delivers on three kind of core value props. You can create assets, tokens, more easily simply by like having a lot of software that can power kind of this traditional process where like today you quite easily have 10 to 15 different service providers, from the valuation agent to the collateral agent, the law firm, the auditor, right, like kind of just to name a few, that like in most cases, especially in the private credit market, like it's very disconnected. And I think while like these days spreadsheets are mostly sent around via email, it still functions fundamentally in the same way as it used to when everything was done on paper, right? And I think like blockchains, like smart contracts, have the ability to kind of create a unified system that all these different entities that don't really want to trust each other or don't really want to kind of like there's sometimes regulatory reasons, sometimes just like practical reasons why they don't operate on the same system, or that they can still actually collaborate. So that's kind of first one, like asset creation. The second one is like the single source of truth that you have by kind of putting this on a decentralized public ledger creates actually a way to have like a data repository that is generally more trusted, right? Like where you have an investor looking at a loan tape that's kind of on a blockchain with like enforced smart contract rules, like third parties contributing data, right? That's like a lot better than like getting a file that you'll have to like audit yourself, kind of verify and do all of these things. So kind of like bringing this data together, knowing exactly like if a token is moved from A to B, you know, that the transfer is executed, there's no like settlement, this ledger is kind of constantly up to date, right? So kind of like just using the blockchain for this ledger and this transparency. And then the third thing, I think, and this is where it gets interesting, because I think actually my view on the future is that there won't really be there's not really a clear delineation between public and private credit. Like we generally say public credit, like has some public market activity, has generally a broader, more liquid market, like maybe it's registered in a country and maybe not, right? But in the end, it's really just a scale of like how much liquidity and like market infrastructure is there for this versus like how illiquid and like bespoke it is. And I think like we see already in DeFi, like Aave as an example, right? Like being a fully automated repo market, it works for a very small number of assets today, but it's like vastly more efficient as an example to like me going to a bank and like asking for a bank line of credit against some collateral and then like kind of drawing down, right? Like I can do this in a second, like $100 at a time, $1 million at a time, it doesn't matter. And so like you see kind of this development in DeFi, I think ultimately will have like much better market infrastructure that is able to deal with the complexity and the like fragmentation, ergo like smaller asset classes that like today are simply not considered public credit because they're like too small, right, to have like these public markets. If we make markets cheaper to create, then we'll end up like with these kind of worlds moving closer together. So those are the three things that we kind of focus on when we talk about tokenization of real world assets, both like in private and public credit.
Thanks, Lucas. That's really helpful. And I think you highlighted some key areas, I think, that would be appealing for many managers. I suppose just taking a step back, Matthew, wanted to, I suppose, before we have listeners on who may be from all different parts of the business or different strategies. So when we talk about tokenization in private credit, sort of what are we talking about exactly? Is it the tokenization of the vehicle holding the private credit assets, or the private credit instrument itself, or both? And just for those listeners who might be new to this area, sort of how does that work in practice, and how expensive a process would it be for managers to integrate?
Yeah, it's a great question, and especially a great question given, you know, the ramp up of the developments in this space of late, with tokenization of the actual vehicles and tokenization of funds and a whole bunch of kind of tokenization developments taking place around the world. But, I think the best way for me to answer this question is kind of to just give some more insight into kind of what Fasanara is approaching when it comes to tokenization. And we're especially looking at the tokenization of the assets, not necessarily the vehicle. And that's kind of, at least initially, and we have a good reason to do this, as we manage kind of the assets of 140 of the world's best fintech private credit origination platforms, who are all in dire need of efficient reach to liquidity to grow their respective businesses. Fasanara is a 12-year-old FCA regulated entity with $4 billion assets under management, that has an impeccable reputation to uphold, which is why maybe our approach may seem conservative in its nature, but we do that for good reason, to kind of prove the use case as an institutional first use case, right? So this year, we've kind of taken hold of tokenization as a strategy, and we've kind of launched with a partner tokenization platform called Untangled Finance, who will be kind of the tech platform needed to write the smart contracts, to provide the KYC AML via third party to investors, as well as kind of provide the data rooms and some of the legalities necessary for investors to familiarize themselves with the investments themselves, and what the tokens really represent. Fasanara in its structure provides a proven and regulated, although, to a lot of people in this space, a dated, regulated existing bankruptcy remote SPV structure based in Luxembourg to ensure segregation of assets between each token. So this is a very kind of traditional way of ensuring investments into private credit, ensuring that there's no commingling of funds between the various pools that investors invest in. And we find that kind of completely necessary, even when we're talking about something as progressive as tokenization. In our initial strategy, we're tokenizing notes representing pools of loans, at least initially relating to 3 originators and 1 kind of diversified funds of various tranches of loans. And that's provided by our SPVs. But soon we'd be looking very quickly to look at how we tokenize the underlying assets, which is in at least our minds way more attractive and progressive to the space, as this ensures investors can kind of look through to the underlying assets from a granular perspective, look at the performance of those underlying assets, and that really kind of necessitates this need of T+0 performance reporting, which is a major hurdle in the space, right? Everyone involved in private credit understands the latencies in performance reporting to inform investors of the nature of their investments. And then in terms of cost, I would say that, in order for Fasanara to provide a regulatory compliant and familiar solution that is kind of institutional first, institutionally minded, with a kind of a tech platform enablement layer, it has very much been expensive, both in time and cost to set up, as we're building something kind of truly native to the existing space, right? I see us as not necessarily replicating the kind of the playbook of Centrifuge or Goldfinch or anything like that, but us kind of taking a different approach, a much needed approach, where the existing industry and the legal contracts are built from scratch to prove the existing structure and how tokenization kind of provides a benefit to the existing structures, and then kind of relating to bank accounts representing these tokenization vehicles, we've reached out to pretty much every kind of crypto-friendly bank out there, and they do not see any kind of structure that they have provided to existing entities to the one that we require. So it really necessitates a ground-up approach, which has been expensive, but we hope that kind of catalyzes the standard for any other institutions that want to get involved in this. And I think that's kind of needed for us to kind of bleed a little bit in terms of cost, but also set the expectation and the standard for the efficiency and the ways in which other institutions enter the space for the benefit of us all on this panel.
Thanks, Mick. That's really interesting. Yeah, obviously you're leading the way, and I'm sure there'll be a number of fast followers coming in behind. So thank you for sort of setting out how you're doing it at Fasanara. Anthony, I wanted to turn to you. At Coinbase, I think as you talked about previously, you've been developing infrastructure that enables access to tokenized products on chain. So do you think tokenization would make private credit investments in particular even more appealing, and why?
Yeah, thanks for having me, James, and it's great to be here with everybody. So a lot of folks kind of resonate Coinbase's brand with just crypto, but the thing that we want to impress upon our listeners today, be they plan sponsors, fiduciaries for the client assets, and investors alike, is that there's a fundamental technology shift happening, and it kind of starts with crypto. And what crypto does is it allows people to engage in a new technology platform that requires a different set of infrastructure, right? And so if you think about the folks on this call, from Centrifuge to Verified to Fasanara and Coinbase, all of us are operating on this new layer of technology, right? And it's the same thing as when we went to adopt the internet and adopt TCP/IP protocols and adopt email protocols, and then started to embed different layers of software into our workflows that help us automate our workflows on a day-to-day basis. That's what's happening today. And Coinbase is a fundamental, foundational infrastructure layer, an access point for users of all types, whether they be investors, underwriters, originators, accountants, auditors, et cetera, to be able to operate in that digital ecosystem, right? Called a blockchain. There are many, many blockchains now. Centrifuge operates on multiple blockchains, including Coinbase's own blockchain Base, right, and others. And so when we think about Coinbase's role, we are an infrastructure provider, right? So you can't operate with digital assets, aka tokens, until you have a wallet. You can't create a token without a blockchain, right? You can't access tokens without something called a stablecoin, right? Generally speaking, right? You need a dollar fiat asset to be able to access a investment product on chain, right? So all of this stuff we're talking about really is the next evolution of software, next evolution of software as a service. And that's why we think it matters for private credit, because what you're seeing on chain, right? When we say on chain is the new online, that's our buzzword. You've probably seen a few media outlets purport that. So on chain is the new online. What that means is Centrifuge's software and the software that Fasanara is using to automate the workflows and automate the ownership structures, right, of the existing process, which create an SPV in Luxembourg, right? That's not new, right? What is new is how you reflect the legal ownership structure of the investors in that SPV and the ownership structure of the waterfall and cash flows of how the funds are delivered and returned back from their investments to the owners in their wallet on chain. And all of that, again, is then powered by infrastructure like a blockchain, powered by infrastructure like a wallet that Coinbase offers. So, Coinbase's role in all this is to kind of build the roads, right? And we like to say we're building highways, and we continue to put more and more roads further and further out into the digital ecosystem so that Centrifuge can build, so that users can access their software, so that eventually private credit funds can retool their workflows. And the goal here is to save costs for them, increase efficiency. And ultimately, we want to get this to a point where we're repackaging ownership structures in a new format called a token that's composable, which means that you can take a token and you can move it around and deposit it as collateral. So Lucas mentioned something like Aave or other collateral pools, right? I can take a digital asset and I can deposit it and borrow against it, right? Governed by smart contracts, not governed by someone's view on perceived risk, right, in a legal contract. It's composable, it's interoperable. What we're creating is smart financial instruments, right, where I can embed logic into the wrapper of a token, right, and that logic determines what happens, right, with cash flows and ownerships and defaults and other things that are part of the investment process. I could also embed smart contract logic around the token and the protocols that it engages with, right? So a lot of this, think of it like if then, if somebody doesn't pay me back, right, do I have a bank and a person sitting there checking a box on a piece of paper or an Excel spreadsheet, or do I have a smart contract that reads it instantly and can lock capital, right? That it's collateralizing that asset, right? Those are the simple things that we're trying to do within every asset class, not just private credit. But private credit is an interesting one because it seems like folks have actually really picked it up earlier than other asset classes to try and figure out some of the tooling here. And ultimately what this means is we do think that blockchains as a global technology layer are truly globally accessible. So we're talking about projects all over the world, right? People are lending in emerging markets, and they're lending in the United States, and lending in Europe, right? This isn't something that is specific to one particular region. Crypto is global, blockchains are global, and so we do think that folks are looking at this space and saying, I now have a globally scaled technology layer that allows me to create a new instrument that has a new ownership structure with enhanced efficiencies from ownership, liquidity, and other things. Let me figure out what rules and regulations work in different regions for me to dive in and create new structures in those spaces that can unlock capital and ultimately create a better investment experience. Long term, we do think Coinbase as an infrastructure and access layer, and all of the companies building these new technology suites are going to be the tools that get ingested into service providers, get ingested into fund administrators to some degree, so that a plan sponsor, for example, that runs a DC scheme can eventually start to retool how they bring alts into that particular plan, right? So long term, we do think it gets there, where this is the technology layer for alternatives, right, private markets, eventually to be investable by a number of different cohorts of investors, from DC schemes to retail, et cetera. In the short term, it's a lot of working with smaller players who are ready and willing to dive in. And I think they're going to be surprised by the amount of progress we're making pretty quickly.
That's brilliant. Thanks for that overview, Anthony. I think that aspect around programmability, I think that's really interesting for this asset class with the smart contracts. Ben, I think there'll be some people maybe from the private credit side who are dialed into this webinar, thinking that tokenization adoption was discussed sort of 6 years ago. They were having conversations then, but progress since then seemingly has been limited. But from what I've read, sort of stronger business fundamentals, certain structural changes that have happened in more recent times suggest that this time it could be a different conversation that they have. What's your view on the state of things?
I think the idea of tokenization is not really a new idea. It's been tested and tried for over half a decade. So this idea of taking an exogenous asset off chain, whether it's private credit or whether it's an LP stake in a fund, whether it's farmland, whether it's an apartment building, this idea of kind of putting an off-chain asset into a wrapper of a token has been this powerful idea. And over the past 5 years, there's been a lot of trial and error. The concept at its essence seems simple, right? You can tokenize something, move it on chain, it moves more efficiently, 24/7, 365 globally. You have the programmability elements, composability elements that Anthony mentioned. But when you really drill into this problem, there's a tremendous amount of nuance. There's lots of legal nuance. There's lots of security and smart contract nuance. And the verb tokenization can mean a number of different things. Some of these projects are tracking ownership on chain, but transactions occur kind of off chain. In other words, you're kind of displacing what are known as transfer agents. In other tokenization experiments, you have ownership tracked off chain, but transactions occurring on chain. So in that case, you're streamlining the kind of assignment and settlement process. And so there's a lot of nuance here. And I remember back in 2017 when there were many projects that would take, an apartment building in Queens and, tokenize it. And there was really no real traction or liquidity or progress there. And, fast forward to today in 2023, and it feels to me like we're really at an inflection point in the evolution of tokenization. And you've seen it this year with everyone from, KKR to Hamilton Lane to, the California DMV tokenizing 14 million automobile titles. You saw, Boston Consulting Group basically say, hey, we're going to get to 16 trillion of tokenized assets by the end of this decade. So it feels to me like there's real momentum building and we're at an inflection point. And kind of to your question of why now, like, why is this happening now in 2023? I think there are really kind of two factors. So the first is stablecoins. So stablecoins are tokenized dollars. So you're putting a dollar in the wrapper of a token. And it sounds very basic, but that has unlocked a tremendous amount of traction in the space. So you have now today $120 billion of stablecoins that are on chain, those stablecoins, the velocity of them equates to about 1% of Fedwire and about 8% of ACH transfers in a given year. So we're at kind of a meaningful scale for technology that's, really just a few years old. And, you've seen PayPal this year come in, launch a stablecoin. You saw, you've seen Visa come out and say that they're going to speed up the clearing and settlement process for credit card transactions using stablecoins. So this idea of a stablecoin, kind of putting a dollar in the wrapper of a token, I think has galvanized a lot of interest. And people look at that and say, well, if we can put a dollar in the file format of a token, can we also do that with private credit? Can we also do that with other asset classes? And that's where you're seeing a lot of interest. That's one thing that I think has certainly changed. We didn't have stablecoins 5 years ago to the same scale that we have today. And then the second thing is, financial contracts, smart contracts. I think the world has woken up to just how efficient these can be. And a little backstory. So I worked in private credit for 10 years before getting into crypto. I was at KKR and TPG. And I remember back in the day, monitoring financial covenants or borrowing-based certificates, and that, receiving amortization payments, excess cash flow sweep, the whole process and supply chain of collecting interest from borrowers, of monitoring their financials is done in an analog format. And there are a number of different intermediaries in that supply chain that I think Lucas touched on. There's, in a typical syndicated loan, there's a calculation agent, a payment agent, a servicing agent, a collateral agent, underwriters, and so on. And that effectively increases the cost of capital for borrowers. And it's effectively value leakage. And so with smart contracts, the beauty of smart contracts is you can automate away a lot of that, a lot of those parties and disintermediate them and produce more efficiencies. And I think, Centrifuge, Lucas and his team at Centrifuge, are kind of, I would say, thought leaders in terms of programming this logic, this kind of typical fixed income logic into smart contracts. And so I think those two things have kind of coalesced. There have been other changes in the space. You now today have big institutions in crypto, BlackRock, KKR, and Apollo and others, that you just didn't have many years ago. Blockchains work better. They're more scalable. There are better software products that streamline the user experience. So all these puzzle pieces have kind of come together in 2023. And it feels, from my vantage point, that we're at an inflection point where we're going to really start to see significant more traction in this category. And the last thing I'll kind of add is, from just a pure data standpoint, we're not talking about something that's theoretical that may happen. Tokenization is happening today. So there's $3.5 billion of tokenized real world assets on chain today, that excluding stable coins, that's up over double since the beginning of the year. This is across tokenized treasuries, tokenized private credit, tokenized gold, tokenized real estate, kind of the full gamut. And my sense is that number will really just continue to grow.
Can I add, James, just a couple
please.
things to Ben's point? So the question is like, what's different today versus 5 or 6 years ago, right? We would also add that we have hundreds of millions of people with wallets, right? So a lot more people in the world have been educated as to what is a digital asset. How do I access this technology layer? How does a digital asset function? They're starting to understand what does atomic settlement mean. So what that means is like, what does it mean when I have a settlement layer and I have a dollar fiat layer, right, in today's world, but those actually come together where an atomic settlement, you don't have counterparty risk. Like once you do a trade with someone, it's automatically and instantly settled, right, as soon as the blockchain processes that block, right? So that's a fundamental paradigm shift for a lot of people. And once you kind of get over the hump of understanding, wow, I don't really need two systems to execute a contract and send fiat, I can do it at the same time, right? People start to open up to understanding what does operating on a digital layer mean, right? So there's a, call it like a mass education happening for people to understand how to use email and how to use digital assets that's going on as well. So that's 5 years matured, 6 years matured across the industry. And so what we have to do from Coinbase's perspective is we have to, I like to compare it to, I got my first computer in 94 or something, right? And I was one of the first couple 100 million people worldwide to get a computer in my house, right? Fast forward 10 years, billions of people have computers, can access the internet. So you also have to understand too that there is an infrastructure rollout that has to take place for individuals as well as enterprises, right? Who then can retool the way they do their business. That's something that's different. One more thing is from a regulatory perspective, we had very little clear rules around digital assets in 2017, right? We had the ICO market that boom and busted, and then we had people pay attention to it. You fast forward to today, in the U.S., it's a problem area, right? We haven't figured it out in the U.S., right? But there's incredible conversations going on here in the U.S. and all over the world, right? And other regions have made a lot of progress, right? So you look at regions like Switzerland and Luxembourg and others that have very clear blockchain rules, right, around the Swiss DLT law that enables somebody to create a digital asset token, and that asset is a bearer asset. They can move it around on chain in a lot of different ways. You have environments like Singapore under the Monetary Authority that have enabled a sandbox for 2 years now for large institutions like HSBC, Apollo, JP Morgan, and others to operate and feel comfortable operating with the public blockchain, right? And then you have a lot of other regions around the world that are pushing into this space from a regulatory perspective to create clear rules. FCA in the UK, right? The EU DLT regime that now has both MiCA and the DLT regime, right? That's starting to take off and gain traction. Brazil has very clear rules, right? So I think there's over 24, 25 different countries around the world that have established or are beginning to establish a clear regulatory framework for institutions to operate with a blockchain, right? And it is something that's really novel and new. And that the new thing is that you have information moving on a blockchain and you have assets with value, right? And so it's important and it's critical to get it right. That we have.
That's really helpful. Thank you for adding those points, Anthony. I think that's a key point on the regulatory side. I think 5-6 years ago, regulators were looking at this space without really knowing how to regulate it. And I think now we're seeing regulators build out teams for digital assets, build out teams for tokenization. That's only happened in the last sort of 18 months or so. So there's definitely been a sort of mindset shift when it comes to the regulators, which I think is a really key point as well. Matthew, you obviously talked about how at Fasanara you are looking at potentially tokenizing the assets. I think you mentioned under 140 private credit platforms, around 4 billion of assets. So I think it would be really, really useful for people listening in, sort of what are some of the challenges or pain points that you've identified when you've been going through that project?
Yeah, so it's the golden question, right? I mean, what does it look like, and what does the pain look like? And I can give you kind of the generic challenges of tokenization of private credit, which I think we all really aware of, which is high cost of funding and slow and manual performance reporting and high minimum investment amounts that kind of prevent accessibility to these assets. And that's kind of, the pain that's incentivizing tokenization as a solution. But like, I think when we talk about delivery of and build of tokenization, some of the challenges that we've faced since the beginning of the year can kind of be categorized into two categories. So kind of push factors and pull factors. And from a push perspective, I mean, that what are the characteristics that need to be addressed to bring a truly kind of palatable and revolutionary product to market, given what already exists. So, by no means do we want to replicate any of the models that exist. I think, the work that, Lucas and the team at Centrifuge have done has been incredible. And we really want to kind of define our path so that we can both benefit as entities pursuing the same kind of outcome of kind of bringing in institutional investors and accredited investors into the space using tokens. So from push factors, these can be things like legal and regulatory elements that both kind of Ben and Anthony touched on. From our perspective, it was kind of assessing the lay of the land into something as basic as kind of what is the governing law for the legal contracts, the legal investment contracts, because certain kind of governing laws like Swiss and even Lux law incorporate an additional kind of fees and taxes that whittle away margins, right, at the end of the day. And either those costs are imposed on the investor or they're absorbed by us. But at the end of the day, that's kind of seen as unprogressive. So what we want to do is kind of make things as beneficial to the entire kind of ecosystem of entities involved as possible. From a compliance perspective, assessing who delivers the kind of the gold standard in compliance solutions that are easily and efficient in embedding themselves into some of the digital frameworks that we want to utilize, but do so in a very UX friendly way, so as not to deter investors when they're engaged into the process. And kind of sadly, you kind of have to split that up into, US investors and non-US investors, because US investors have way more stipulations into the extent to which they're KYC'd. So, splitting that up is very important, but also painful to kind of ensure that there's efficiency in
quite a painful process for US investors. And then, I touched on before, bank accounts. Ever since kind of SVB and Signature's failings, the kind of crypto-friendly banking framework has kind of been consolidated into a very small amount of players that support kind of the tokenization structure that we want to build, and finding those bank accounts that can be embedded into the structure that are discretionary enough into the extent to which they can construct something that's really novel to our needs and idiosyncratic kind of requirements, is quite tough. And then kind of lastly, on a push perspective, kind of the legal service providers. So, looking at the law firms that are capable of constructing ground up legal contracts, who are knowledgeable enough in the space and progressive enough to kind of talk to tokenization as a solution, but also are aware of the regulatory kind of idiosyncrasies governing some of these elements in certain jurisdictions, and make sure that, that's an efficient process as well. So, finding these players, which are kind of fairly easy to do in the traditional world, is quite difficult and challenging in kind of the decentralized finance world. And then from a pool perspective, it's fairly generic. And although there, Anthony and Ben touched on the education that has taken place to
bring this world to the fore of being fairly adaptable and adoptable by institutions today. There is still an education that needs to be done on the benefits of tokenization versus kind of the structures that exist in the traditional financial markets. And that education is quite painful to do, given some of the events that have taken place, especially in private credit, where you're seeing, players like Goldfinch and unfortunately lay victim to some defaults of recent, which does a lot of damage to the entity itself, but also creates skepticism in this space, which is not healthy for anyone building solutions in this space, because it's kind of, we take two steps forward, but certain events like a default push us back a step, and we kind of need to re-strategize and reincorporate the value that we provide, that's different to the extent to which some platforms are unfortunately victim to some defaults, and then kind of there's the accessibility thing from a pool perspective, which is how do you bring in an entirely new subset of investors to private credit? So traditionally, private credit was almost exclusive to large institutional players that had minimum investment amounts of over $100,000, if not more, to get access to these assets. So how do we bring in, through tokenization, these sophisticated and accredited investors, which tokenization does provide access to, who have $1,000 to $5,000 to $10,000 to invest? How do we make sure that they are aware of what these assets are, the structures involved, the value involved, and how they kind of form an integral piece to their portfolios? So I think those are some of the challenges, and some of the challenges that I think we're all working on. I think it's very exciting challenges to be working on. And again, laying the foundations for kind of the accessibility, bringing on kind of the next iteration or generation of investors into a decentralized finance type environment.
That's great. Thanks, Matthew. There are a couple of things there that you reflected on that I want to discuss further. So maybe, Ben, firstly with you. Matthew talked about sort of banking issues, and a lot of those, I suppose, can only be resolved to a certain extent through regulatory change, whether it's Basel framework or other areas. But a more general question is sort of, given you were in the TradFi space before, do you see the TradFi space starting to get behind this new mechanism and process? Because arguably it could lead to disintermediation. What are you seeing sort of from the bigger institutions in terms of entering this space?
I think the answer really depends on the type of institution. So, if you kind of break TradFi down into, asset management firms and banks, I think we're seeing activity across both. But I would say for asset management firms, they're seeing this more as an opportunity. Whereas with banks, they're seeing it as an opportunity, but it's also a potential risk to their business model, because banks tend to be all of the intermediaries in a typical financial transaction that could get disrupted by this technology. But there's innovation across both categories. I think in chatting with institutions around this theme for the past couple of years, I think there's just broad acknowledgement that tokenization makes sense. Like it offers more efficiencies, and it could produce cost savings and for these firms. So there's certainly appetite to really dig in. And if everyone could snap their fingers and we could be in a world where all assets were tokenized, all traded on chain, that is like I think a state of the world that people want to move towards. But I think getting from where we are today to there are challenges along the way, and it's not going to be it's not like we're going to get there tomorrow. But what in terms of actual examples, you asked about what examples of TradFi involvement are you seeing in the space today? We see a couple hundred different real world asset tokenization projects that are live in the wild today with real institutional parties, and then maybe 500 to 1,000 others that are in pilots in the pipeline that are launching soon. I'll highlight a couple just to give a flavor. So, one example is there are the private credit platforms where you have groups that are tokenizing private credit in a typical securitization structure. So Centrifuge is one great example of that. Another is a firm called Credix, which is mostly focused on emerging market credit. And they have originators in emerging markets that are doing invoice factoring and putting up first loss capital. And then behind them, you have people on chain that are contributing kind of senior capital against these invoices. All the payments are occurring on chain. There was a large private credit fund called Variant that recently committed to putting $60 million on that platform. That's one example. You've also seen, and these have been more public for a while, but you've seen firms like Hamilton Lane, Apollo, KKR take LP stakes in their private equity vehicles and tokenize them on platforms like Securitize or on the Provenance blockchain. And effectively, the idea there is, one, if you're a large firm like a KKR, it doesn't necessarily make sense for you to take $100,000, $200,000 tickets. So this is allowing you to access a new channel of LPs in an efficient way. Also, the transfer and assignment agreement for selling an LP stake in a private equity firm can take many weeks. Those markets tend to not have a lot of liquidity. So through tokenization, you can kind of diminish some of those costs and time that it takes to actually transfer your stakes in those firms. So you're seeing a lot in the LP stake world. And then the third bucket I'd call out is, I would say, more of the banks and institutional groups that are tokenizing real world assets on private blockchains. So JP Morgan coin is one example, which is JP Morgan on its private blockchain called Onyx is effectively tokenizing deposits at its bank, and you have banks like Goldman, BNP, and others that are settling transactions for short-term loans using these tokenized JP Morgan deposits, and that's reducing settlement times from 1 to 2 days down to a few hours. You're also seeing JP Morgan coin and some of these other kind of, I would say, tokenized bank deposits used in international settlement. So the typical wire today that you're sending out from the US to internationally goes through 2.6 correspondent banks and takes between 3 and 5 days to settle. And so the idea is using stable coins, you can reduce that to effectively hours and also reduce the cost. So there's a lot happening there. You're also seeing it in the repo market. There's Broadridge is a firm that's basically doing repo using tokenized treasuries and tokenized stablecoins. They're doing over $1 trillion of these transactions every month, which is less than 25 bips of the total repo market, but is growing. And so, and they're onboarding a number of different participants there. So, there are numerous examples of this that are, taking place today. And I think that TradFi will get behind this. They are getting behind this. I think, everyone on this call probably spends a lot of time talking to large financial institutions and taking their pulse on this trend. And what I've also found, really encouraging is there is, I think, broad acknowledgement that this is the better way, right, versus the system we have today. And within these firms, as you kind of dig and talk to people, there's a strong desire and impetus that's really top down and bottoms up within these organizations to use tokens and to experiment and explore real world assets. And that has accelerated meaningfully this year. I think in part because of the banking crisis, in part because, as Anthony points out, the regulation and the technologies is much more usable than it was in the past.
Brilliant. Thanks, Ben. a lot happening, a lot of moves being made, which is really interesting. Lucas, I wanted to turn to you, sort of in terms of what you've seen in terms of the market. I think you've been established since 2017. It'd be interesting to get your perspective there, where we are today, and then what do you think will really move the dial beyond sort of some of these test cases or pilot programs? What will it take for sort of mass adoption? What's the trigger going to be, I suppose?
I think, yes, we've been around since 2017, and then most of what we're talking about were like probably the first ones to ever do a lot of these things. We deployed the first structured product on chain, implemented a like on-chain NAV, daily NAV, or actually each block a NAV, so you'd have a kind of up-to-date view on the portfolio with like waterfall structures, junior, senior tranches, and so on. Then like we also kind of were first to figure out, okay, how do we integrate this into other DeFi protocols and just kind of scale from like the first 10 million to the first couple of 100 million to like now where this entire industry is in the billions, as Ben said. I think kind of looking back, like it was really a slow slog towards like getting just any kind of activity on chain, and also like just getting to a basic understanding of what the technology can do and why it is good for financial institutions. I think the conversation we're having today, like we couldn't have had 2 years ago. So kind of looking back at the progress we've made, like what would I say is going to happen next? We are still at a point where I think for many institutions, it's not a viable like investment or kind of in infrastructure, legal, etc., to kind of do these transactions on chain today at scale. I think there's the two biggest hurdles are, to some extent, like the technology is just not established enough. Like we have 6 years of experience in building this. We spent tons of time and money on auditing, making sure all of this is safe, actually scaling it. And we're still only able to cover like a very small fraction of kind of like the whole process. That's just kind of finance is a pretty hefty beast, and like even getting like a single structure on chain, right? It does require a lot of work. The other point though is I think it is just regulatory clarity on some of the things we use, like stablecoins. I think without a clear comfort by larger institutions actually to use stablecoins for settlement, a lot of these on-chain versions don't actually make sense, because the minute you detach settlement from the actual like on-chain contracts, which a lot of larger tokenized products have actually ended up like not taking subscriptions in stablecoins, not actually paying back investors in stables, but like merely tokenizing the ownership. And I think a lot of that like negates like a lot of the benefits that this technology has. So for me, that's like probably the biggest, those two like kind of but first of all, just time and kind of more scale and more tech maturity, and second of all, the like regulatory side, those are the biggest kind of inflection points. We're at a point where like I think even among skeptics, like people do believe that tokenization can have benefits, and that if that technology actually works, this will make a lot of sense. So I think we're past that stage of like trying to convince people. It's more about like trying to show them that it's actually possible at scale. And so what we're working towards is like growing kind of within the on-chain native, the crypto native lenders, because those are the ones that are most willing to experiment with this technology today, that are not seeing this technology and the regulatory risk as like something they're not already have to be extremely comfortable with, right? And that's like DAOs, stablecoins like Maker, where we have 200 million in like available like basically credit lines for users of Centrifuge, or working with a BlockTower, that's like a crypto hedge fund that actually launched a private credit fund with us, and kind of is also intimately familiar, right? Like kind of finding those early users, just like keep working on those other like necessary building blocks and kind of proof points that we need to actually get to a point where we're talking about the like 150 trillion in like assets under management in the asset management industry, right? But yeah, I would say like that's obviously where we're going, whether that's in private or public credit. I think both will actually just be talking about tokens in a couple of decades from now, maybe one, maybe two.
That's great. Thanks, Lucas. And good to sort of know what the hurdles are. need to be overcome. Nick, wanted to turn to you. A couple of things here that have been discussed. I suppose this accessibility, so to new segments of the market and new investors. Do you think that's something that could appeal to private credit managers looking to tap into the retail segment of the market? And then just another question, I suppose, whether hedge fund managers really want some of the illiquid assets to become more liquid. What's your thoughts around those things?
Thanks, James, for two easy questions in the 3 or 4 minutes we have left. So in terms of asset raising, so the private credit is primarily an institutional market. So I'd say in excess of 95% of the capital currently being invested comes from pension funds, insurers, sovereign wealth. There is a trend towards seeking to grow retail capital. And here you're probably looking at a few things. Like one, from the perspective of the retail investor, cost and accessibility are probably the two most important things. So while tokenization of private credit funds or token assets that provide some sort of access to these assets or exposure to these assets is potentially of interest to firms looking at that as they look to grow a retail capital base, you have other options for them. So in the United States, we have business development companies which are 80% retail capital, very, very accessible today. In the UK and Europe, we've recently established or refined funds like the Long-Term Asset Fund and the European Long-Term Investment Fund that provide retail investors with a means by which to access these assets. There's also initiatives to provide people with exposure to listed private credit fund managers. So again, like indirect, but extremely cheap. So I think while there's opportunities here, it's certainly not the only game in town. And then on your second question around liquidity, I think at the moment, people are being paid to find assets that investors cannot currently get exposure to. That's one of the attractions, the diversification benefits, non-correlated returns. So the more liquid you create those assets, create these funds, these vehicles by which people get exposure to them, perhaps that balance shifts. As with all types of assets and investors, there's different risk appetites out there. Our data shows that some investors do want more liquidity or have an increasing demand for liquidity in terms of their exposure. This can be managed in a number of different ways through traditional fund structures by adjusting the composition of the assets in the fund. Again, tokenization would potentially be one area. I think where there would typically be a seed of doubt in a credit fund manager's mind would be in relation to control. So the moment you tokenize these assets, you potentially disperse control. And so far, one of the attributes which has served the sector well is being, that direct relationship with the borrower, the ability to intervene, to take action, to ensure the investor's value is protected. So while, again, there will be investors who would be happy to have a more liquid structure, and tokenization can be one way of achieving that. There would still need to be a consideration of what is the product we're selling here, and is it consistent with what we think we can do as a manager. So hopefully that's okay in the time available, James. It'd be good to talk about these in more detail with more time in the future.
Sure. Thanks so much for that, Nick. And I see we're up at time. As always, there's so much to discuss with this topic, and just wanted to thank all our speakers today for sort of sharing their insights and observations with you. We'll definitely be doing further programming on this topic, as I know that there's growing interest. So hope to have you back on for future programs. But thanks to all of you for joining, and goodbye for now.
Thanks for having us.